We might look at the 10-year yield and think everything's done, the worst is behind us, but there's one very crucial aspect of this market and this market pricing that I think needs to be revisited by the banks, by the broader consensus, and potentially revised. And that side of the equation is 2024 earnings. So let's back up the truck a second. The 10-year yield has reached this new high, this multi-year, over a decade high, the highest level since 2007, which is a very tumultuous time, high rates, leading to breaks that took long periods of time to play out. If you've seen the movie The Big Short, and if you haven't, I highly suggest you watch it. And if you have, I highly suggest you rewatch it. Took time to play out. These rate effects took time to play out. Nonetheless, the Fed has desired to keep interest rates higher for longer, pushing out those first cuts, increasing the expected year-end interest rate. This is very different from what the market was expecting at the beginning of the year when this rally began to occur in March, May, and April, and even earlier than that in February and January. But most importantly, the SVB period was very, very big for interest rates. People expecting them to be lower, the Fed to have broken something, and cuts to have happened. That is obviously not developed. So, at one point earlier this year, the market was forecasting rate cuts starting as early as later this year, and dramatic, big-time cuts return to so-called normal next year. Now, the interest rate picture, which is the risk-free rate of return, determines the risk, everything. Determines equity valuations, determines real estate valuations, everything. Has now gone higher and for longer. So that is not something that simply exists in a vacuum. That is not something that we can just look past for a year and do things based on, when rates are going to be lower in possibly 2 years. The idea here is that the Federal Reserve is actively trying to restrict the economy. They talk about being in restrictive territory. They've increased interest rates all this much, and they haven't seen the kind of cooling in the economy that they were once hoping. So they've decided to go higher for longer. But my read on the 2024 S&P 500 earnings is that this hasn't adjusted. If you look at what the projections are for 2024 earnings, in my opinion, it becomes very clear that this is essentially a relic of the post-SVB. The Fed has broken something. They're going to have to start cutting sooner and lower for long or lower for shorter, whatever the saying would have been. That caused tech to massively outperform after SVB. And interest rates to fall and take so long to finally break out from their 2022 year-end highs. If you look at 2024 earnings, it's a very consistent, just really big re-acceleration. I'm talking, you have Q4 2023 at $52 a share, and then you have Q4 2024, or Q4 2023, at $60 a share. That's what? More than 10%, something like almost 15% earnings growth? That's a lot of earnings growth. 15%. But that would have maybe made sense if the Fed was going to be in some sort of interest rate cutting. We would have totally had a complete soft landing, economic reacceleration. But the saying is, don't fight the Fed. So if you're not fighting the Fed, what are you seeing? You're seeing a Fed that wants to cool the economy, not see it reaccelerate. If the economy does reaccelerate, what do they want to do? They want to raise interest rates. They need to see a sustained period of below trend growth to be confident that inflation is under control. And 15% year-on-year earnings growth is not a sustained period of below trend growth. That is very hot growth. That is extreme. I don't even know if we've had something like that ever. I mean, maybe we have, maybe Q1 2020 to 2021. that kind of stuff is the numbers we're seeing. These are big numbers. These are big numbers. And it's just a straight shot up. I'm looking at all these quarters. It's just boom, 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 boom. Q1, Q2, Q3, Q4. Just straight shot. Smooth sailing. My point here is I don't think the smooth sailing is going to come. I think these numbers are going to have to be adjusted. And I think the forward multiple is going to have to be revised down because student loan payments are coming online. Interest rates are going up. You look at certain areas of the market, retail, showing signs of weakness. Even companies like Nike, who reports earnings later this week, I expect we're going to hear some stuff out of them. Rite Aid declaring bankruptcy. I mean, there are signs out there. I'm seeing them. I have a pinned tweet on my Twitter that shows some signs of economic weakness. Rising credit card delinquencies, auto loan delinquencies, record high subprime auto loan delinquencies. There are signs out there. However, when you look at 2024 earnings expectations, they're very, very high. Very, very, very high. Too high, in my opinion. So I would definitely be a little concerned about that if I were a bull. I would definitely encourage these banks to reanalyze the situation. I'm not smart enough or resource built enough to come up with my own in any serious way 2024 entire S&P 500 earnings expectations, but I guess some banks are able to do that. And definitely lots of market analysts use those projections to make their buy and sell decisions and market analysis decisions. So I think there's a little bit of a mistake here, a little bit of a something going on. I'm just making this video to bring it to your attention. Definitely take a look at this for yourself. I don't think these numbers are going to be accurate. I think these are a relic from when people were expecting interest rate cuts sooner rather than later, much sooner rather than later. And the market is now beginning to reprice interest rates, reprice forward looks. Equity markets have pulled back, but I don't think have pulled back enough. I think this is one of the nails in the coffin that has to hit. I'm looking at it right now on Y charts. Hasn't hit yet. I think it's going to hit, and I think there's going to be other things like oil prices that shake things up a bit. So, that's today's video. I want to bring this to your attention. Until next time, peace out.